Options can be this incredibly powerful tool for investors. They let you build these really sophisticated strategies that go way, way beyond just buying a stock and hoping for the best. But let's be honest, with that power comes a level of complexity that can feel, well, pretty intimidating. So in this explainer, we're going to pull back the curtain and demystify the hidden forces that are really driving your options trades. All right, let's just jump right in with a big question. Think about it for a second. How is it even possible to make money from a stock's movement without ever actually owning the stock? How can you profit if it goes up, down, or even if it just goes sideways? The answer to all of that, well, it lies in the very unique world of options contracts. See, when you own a share of a company, you're pretty much just hoping the price goes up, right? But options, that's a whole different ballgame. They give you this incredible flexibility. You can speculate on which way a stock is going to move, or you can even use them as a kind of insurance policy to protect your other investments. It's this versatility that makes them so attractive to so many traders. But, and this is a big but, here's the catch. While the potential is absolutely huge, the risks are just so much more complex than with a simple stock purchase. It's not just about what the stock's price is doing. There are these other kind of hidden forces working behind the scenes, and they are constantly messing with the value of your position. And that right there is the heart of the problem. An options price isn't just one simple number. It's more like a giant puzzle. It's a moving target that's being pushed and pulled by the stock itself, the relentless ticking of the clock, and the market's overall mood, or what we call volatility. And this is all happening at the same time. So how on earth are you supposed to keep track of all that? Well, the answer is to think of it like the dashboard in your car. You wouldn't drive down the highway without a speedometer or a fuel gauge, would you? Of course not. For options traders, that dashboard has a name, the Greeks, and it gives you all the critical readings you need to navigate the market safely. The Greeks are basically your diagnostic tools. Instead of just guessing and hoping for the best, you can use them to isolate every single risk factor, time, volatility, price, and see exactly how each one is impacting your trade. They take that confusing puzzle and turn it into a set of clear, manageable numbers. So this table right here, this is basically our roadmap. We're going to look at the 4 main gauges on our dashboard. We've got delta for direction, gamma for acceleration, theta for the impact of time, and vega for the market's mood swings. So let's break down the first one. Okay, first up, let's talk about the big one, the one you'll hear about most often, delta. If we're sticking with our car analogy, think of delta as your speedometer. It tells you exactly how fast your options price is expected to change when the stock price moves. In the real world, this is your go-to frontline risk meter. It gives you a hard number that answers the simple question, if this stock moves $1 right now, how much money am I going to make or lose? It's the most direct way to measure your exposure to which way the stock is headed. And this is just perfect because it shows you exactly what kind of bet you're making. For call options, which, make money when a stock goes up, delta is always a positive number, somewhere between 0 and 1. And for put options, which profit when a stock goes down, delta is always a negative number, between 0 and -1. Okay, let's put some real numbers on this to make it super clear. Let's say you own a call option and it has a delta of 0.40. If the stock price jumps up by $1, your options value is going to gain about 40 cents, assuming nothing else changes. And if the stock drops by $1, you guessed it, you would lose about 40 cents. It's really that simple. But delta has this other really cool trick up its sleeve. A lot of traders use it as a kind of quick and dirty shortcut to estimate the probability that their option will finish in the money. So a delta of 0.30, like you see here, suggests there's roughly a 30% chance of that happening by expiration. It's a super handy mental shortcut. All right, so if delta is your speedometer, what's next? Well, now we need to talk about the accelerator pedal, and that, my friends, is gamma. It tells us how quickly our delta, our speedometer reading, is going to change. It's all about acceleration. What gamma really does is measure how stable or unstable your delta is. If you have a high gamma, it means your position is really sensitive. Its entire risk profile can change dramatically with every single dollar the stock moves. This is the Greek that tells you if you're in for a nice smooth ride or a wild roller coaster. And this is why gamma is such a double-edged sword. When a trade is going your way, high gamma is your absolute best friend. It's like hitting the nitrous button on your profits. But when that trade turns against you, Gamma becomes your worst enemy because it accelerates your losses just as fast. So there are a couple of key things you got to know about gamma. It's always highest for at-the-money options. That's the point of maximum uncertainty, where your directional risk can flip on a dime. But as an option gets way deep in the money or way out of the money, the outcome gets more certain, and gamma just kind of fades away to zero. All right, let's shift gears. We've talked about what happens when the stock price moves. But what about the forces that are working on your option even when the stock is sitting perfectly still? These are the unseen forces, and we measure them with theta and vega. People often call theta the silent killer for option buyers, and for good reason. It represents time decay, and the absolute best way to picture it is as a melting ice cube. Every single day that goes by, a little piece of your option's value just disappears. It melts away forever, and there's nothing you can do to stop it. And here's the kicker. That ice cube doesn't melt at a nice steady pace. Oh no, you can see it right here in the table. Early on, the daily loss might be around 45, but fast forward a few weeks with only a few days left, and that daily loss more than doubles to over 93. This acceleration is why hanging on to a losing option in its final days is so brutal. The ice cube isn't just melting anymore, it's practically hemorrhaging value. So it all boils down to this one, super simple but absolutely critical rule of thumb. If you are buying options, time is your enemy. Theta is constantly, silently working against you. But if you are selling options, time is your friend. You're the one collecting that daily decay as your profit. And last but not least, we've got Vega. Now, Vega is a different beast altogether. It has nothing to do with the stock price right now or with time. It's all about measuring fear and uncertainty in the market. When the market thinks big moves are coming, like right before an earnings report, volatility goes up. And when volatility is higher, options get more expensive for everybody. Vega tells you exactly how much your option's price will change for every 1% pop in that volatility. Okay, wow, we've covered a lot of ground. We've looked at the 4 main gauges on our dashboard. So what's the big takeaway here? What does this all mean for you? Well, it means you can finally shift from just guessing to trading with real, genuine insight. So how do you actually put all this to work? It's really a 3-step process. First, just master the main 4. Really get what each of these gauges is telling you. Second, start to see how they all interact with each other. And finally, use that complete picture to stop making simple bets and start actively managing your risk with smarter strategies. And really, that's the ultimate question you should be asking yourself with every single trade. Understanding the Greeks is what separates just making a bet from actually building a strategy. It's what gives you the power to see the full picture, so you can stop guessing and start making truly informed decisions.